jumping to this second panel, part 2 of our 3-part panel. This one is going to be specifically about mezzanine and subordinated debt. So again, part 1, we kind of had a macro view, digging a little bit more on the micro level as far as defining opportunities in mezzanine and subordinated debt. So start with you guys introducing yourselves. We'll start with you, Frank. You're up at the top of the screen here.
I am Frank Scavone. I am the Executive Managing Director of Third Point Real Estate Strategies. I'm also the Managing Partner of Trawler Capital Management. Third Point is a roughly $19 billion platform. I specifically oversee about $1.5 billion in distressed credit, the family office assets of Dan Loeb, and of course the Trawler Capital Management Credit Fund.
Perfect. And jump down to you, Thomas.
Great, thank you. Hello, everyone. Tom Hester, Managing Director, Stepstone Real Estate. Stepstone Group is a global private markets advisory and management firm. Our asset classes are private equity, real estate infrastructure, and private debt. We're about $427 billion in private capital allocations, $86 billion in assets under management, 580 professionals across the globe. Stepstone Real Estate is about $134 billion in private capital allocations, $8 billion of assets under management, which consists primarily of co-investments in secondaries and in SMAs and a dedicated fund series, and about $14 billion in annual commitments on behalf of our clients. Of that $14 billion, I'd say about 25% or around $3.5 billion is in debt commitments, focused primarily in the US, but also across the globe. We have 71 professionals in Stepstone Real Estate in the US, Europe, and Asia, and I lead the US credit sector team.
Perfect. Thank you, Tom. And Josh.
I'm Josh Zegan, Managing Principal and Co-Founder of Madison Realty Capital. I started the business about 17 years ago. We are a vertically integrated real estate debt platform. We also have an smaller equity arm of the company as well. We manage just shy of $7 billion of assets. We typically invest in all ends of the kind of debt business, from first mortgage, mezz, pref, acquisition of performing and non-performing loans, from all ends in terms of higher value add, sort of interim bridge financing, land, and transitional lending. We have New York, LA, and Miami presence.
Perfect. Thank you. And again, thank you to all of you for joining. So jumping right into the questions we have. And again, I just want to remind you guys that if you have questions of each other, feel free to jump in, cut me out of the discussion, whatever. But jumping to the first question, I mean, what would you say as far as the kind of defining the key fundamentals of mezzanine and subordinated debt is what you're hearing and what you're seeing? So maybe start with you, Josh, on the key fundamentals of mezzanine and subordinated.
Well, from our perspective, I mean, obviously it's always about last dollar exposure. And, we do mezz and pref, but a lot of times what we're trying to do is originate a whole loan and create our own mezz, B note, pref position by originating the whole loan. And one of the things we find advantageous about creating that whole loan is we're able to drive the documentation, drive the borrower relationship, and being the last dollar, we typically service everything. So one of the things we find is we're able to extract, we think, better returns by originating that whole loan rather than just originating the mezz or pref in conjunction with a senior lender. In addition, I think one of the things we see as an opportunity is a little higher value add opportunities around mezz and pref or whole loan origination, because it's not as commoditized as sort of transitional lending. While there's opportunities obviously in transitional lending, creating that opportunity, creating the opportunity to build a building and then ultimately getting taken out by a transitional lender has driven a little more yield to our platform.
Okay, interesting. Yeah, maybe same question to you, Frank. Just as far as kind of the key fundamentals of mezzanine and subordinated debt right now that you're looking at, or again, that you're hearing from investors that you're talking to.
So I think Josh's first point was dead on, right? Our last dollar exposure means everything. If you look at our last dollar position, assume that it's in the 70-ish% loan to value range, we're essentially investing at 2015, 2000, depending on kind of what asset class you're in. We're investing in 2015, 2014, kind of 16 values, right? So we all readily do that, knowing, you know, in the rearview mirror how values have escalated. The second driving element is current income. And, you know, we all think about yield, right? And love to post great performance yields. But when you're experiencing on a current income basis, obviously you're reducing risk with every dollar you receive. So that really matters. And then I think that, you know, there was a comment made, I forget who made it on the last panel, about, you know, fundamentals being, you know, still relatively sound and lenders being relatively disciplined and all that kind of stuff. And I generally agree with that. I mean, you can pick a player and see how they're interacting within the market. We see a lot of deals that we're very happy to let go at the levels that they're being done. But the reality is that with values where they are, the tide hasn't really gone out. So you really can't, even though we went through a pandemic, the reality is that we haven't been fully tested. And so the last fundamental element is, where in the risk spectrum are you playing as it relates to development transactions, bridge transactions, where there's still some element of transition or risk or execution risk at the property, or if you're really dwelling in kind of that stabilized kind of component rents in place arena.
And Tom, thoughts on that?
Yeah, you know, what I would say is we kind of, you have to chop it up a little bit. So for example, I'll give you some examples. You know, we're very bullish on senior mezz, and those structures, or the opportunities that we see from, you know, advisor standpoint, are typically in open-ended fund structures. They create a risk profile of what I'll call core plus, and my own personal definition of core plus is, you know, one incremental material risk that would prohibit an asset from, you know, from being eligible for long-term permanent life company debt. But at that level, which is purely institutional, I mean, it's a different market today. Mezz today is not mezz the same as it was in 2007. It doesn't compete much, if at all, with equity. It's really topping off a senior loan, okay? 7 to 8% net is great for our clients, most of which have funding obligations, whether they're a public pension plan, an ERISA plan, or a life company. But on the other hand, if you just look at straight mezz, you know, we're going to focus on the quality of the underlying asset. And here the sponsorship may vary. So for example, in New York City, everywhere you look, there's a $75 million asset. That could be local or regional ownership, but it could be a great asset. In that case, if there's capital that's required from the borrower, it may be a trade-off between, you know, raising more equity, amending the LPA agreement, or amending their operating agreement, and they don't want to do that for whatever reason. And in that case, mezz could be attractive because in that case, really is competing with equity. So we'd be willing to, you know, there's a little bit perhaps more sponsorship risk there, but again, there's great assets out there that we like in that space with the right groups. And then the last part I would say, and this is probably a more selective group of opportunities, is pref equity, which is de facto mezz behind agency senior debt. Again, there are only a handful that do this, but that's something that that we find very attractive as well.
We just did that exact transaction on a beautiful new multifamily asset, and the only problem with it is I can't find 10 more like it.
Yeah, yeah, understood.
Well, and maybe jumping, or stay on you for now, Tom. I mean, one of the questions, again, we kind of had predetermined is as far as return ranges. So maybe kind of start there as far as referencing pref equity to mezzanine, subordinated debt. I mean, what are the ranges that you're looking at right now?
Well, you know, as I mentioned, you know, in a fund structure, they typically tend to be open-ended for senior mezz or very, very high quality mezz product. I think that our clients are satisfied with 7 to 8 net, and that's after, 75 to 100 basis points of management fee. It's typically a non-promoted product. But
Okay.
then, that other example I gave of the $75 million office building, New York City, wherever it may be, with regional local sponsorship, you can go up into the teens. It all depends on the risk tolerance. And the way we kind of look at risk there are three main knobs, right? There's the market risk or the collateral, then there's the sponsorship, and then the amount of leverage. And we apply, with Mez, we're talking about structural leverage, but even for the typical garden variety closed end bridge loan, 3+1+1 products out there, and there are a ton. That's subordinate debt too, because the fund's equity is going to be subordinate to any facilities or capital markets executions, CLOs, et cetera, that may be sold off to help finance those positions. So in Mez, it varies. And, I think that in Mez, we like the space now. It tends to be more challenging because you really have to go in. One of the things that we like to say in around Stepstone is that the really good lenders have great equity chops. We don't really see it going the other way around, or going the other way. A really strong equity investor may not have that kind of what we call credit sense. Remember, ultimately you want to get repaid. So we think that you really have to get it right, and you have to price it correctly at origination. And when it comes to Mez and higher yielding debt instruments, we'll lean into some of those equity chops as opposed to, just straight credit sense when we're evaluating those opportunities.
Josh, any different views on return ranges, and then maybe even staying on you as far as that it comes down return? There's obviously the risk side too. I mean, as far as tools to manage risk to get those different returns.
Yeah, I mean, in the stuff that's just like literally fully leased, or like Tom said, core plus, it's a range of like 6 to 9% or so. When you start to talk about more transitional kind of assets, it's generally between 9 and 12. And then for the highest value add kind of stuff, construction of a building up to 75% of cost, or sometimes 80% of cost, that's generally like a 12 to 18% kind of range. And from a risk standpoint, I would say on these, not as much on the stabilized side, but even on the stabilized side, you have more interest rate risk, because the question is, we all know interest rates are going to go up at some point. Do rents catch up with that interest rate expansion potentially? And one of the things we like about a little more the higher value add space, there is more risk in the sense of getting a building complete. So there's a sponsor risk, execution risk, cost risk. But at the end of the day, if you can create that building at 75% of cost, even if rates go up, there should be some sort of a balance in terms of LTV, because you created all the dollars to build that building. And generally we're at 60, 65 LTV, even assuming rates going up. A lot of that is because when we look at debt yields, when I'm doing a construction loan for a multifamily building, I'm probably at a 7.5% debt yield, when there's about 250 to 300 basis points of margin when the building's done, when it's complete. So those are some of the things we think about.
Okay. Frank, what about same kind of dual pronged question as far as kind of the returns, kind of hammered that, but as far as strategies to manage risk when you're trying to get those higher yields? I mean, previous group, all investors are hunting for yield right now, but obviously there's risk involved. So I mean, what's tools for managing that risk?
So Josh is right. I think he gave a very good overview of the kind of segments of the market in terms of what different risk profiles are yielding. All those are gross yields, by the way. So then based on what the manager is and how the manager is structured, unlike I'm not sure how many kind of discretionary funds for even stabilized debt are structured at less than 1% and no promote, because an origination platform by its nature generally costs about 100 to 110 basis points to run. So you really have to get up to some critical scale. So I agree with the risk and yield segmentation that Josh laid out. In terms of manager tools to deal with risk. So there are two types of risk, right, that you are really dealing with. Forget about macro risk, and we can talk about that separately because it's very specific to the strategy that you run. But there are two types of risk that every lender faces: event risk and maturity risk, right? Event risk is something really bad happens during the term of the loan, and maturity risk is something, the property is unable to either sell or refinance at a level that takes it out. So when you think about these risks, right, someone made the point before, perhaps it was Tom, I thought it was a good one. There's a very different perspective being a credit guy versus being an equity guy. And your job as a credit guy, you do have upside, but your job as a credit guy is just to get paid back, right? Get your yield, have as few disruptions in the portfolio as possible, and get paid back. So what you're looking to do as you focus in on event and maturity risk is structure in any way that you can to deal with things that you anticipate may go wrong, or the likelihood that the debt structure that you have in place, your last dollar exposure, isn't comfortably low enough at the maturity of that asset so that you can get taken out. That's generally how we approach it.
Yeah.
Okay.
Can I make a comment on that?
Yeah.
Yeah. So it's interesting because I think Frank hit it, and Josh as well, that, that the strategy and the tools to manage and mitigate risk for a lender really are established at origination. And if you look at, if you're an equity investor and you price an asset at a 15 IRR, well, you can perhaps through superior asset management get a 17 out of it. Or you get that 15, but through superior risk mitigation, you reduce the risk on a risk-adjusted basis. You get a higher return. In both cases, you get an outsized return. You don't have that opportunity with debt. So you have to get it right when you originate the loan. So we focus in, so for example, on underwriting, and I'm talking about, primary origination hold to maturity type strategy. Look at the underwriting, look at the depth of that underwriting. And as Frank mentioned, we look at structural elements in the documents to help mitigate those risks, and of course, pricing. But it's really, it is very much a different analysis. When we diligence lenders, we're always talking to asset management people, and we appreciate what they do. But the reality is, if everything goes right, it should be pretty smooth ride, right? For if it's a bridge product or construction loan, of course, you're going to be managing budgets and business plans and so forth. But we really put a focus in on the investment committee protocols, structure, and the ability to to be superior underwriters at the jump.
Piling on, I think it's a very important point. It's all at the point of purchase that Tom makes. I would extend that and say not only is it the specific structure for that particular loan, but it's the structure of your fund. Open-ended funds are, in my personal opinion, far and away better prepared to deal with the occasional dope who decides not to pay you back. And the second part that's critical is in the platform, right? Getting as investors come in, as LPs come into this, one of the most important points that they could focus in on is the lender or the fund manager's ability to pursue collateral. If you are a group, I've used this analogy to joke around. If you are a lender that does not have the ability to pursue collateral and a long history of successfully doing that, the borrower knows you're in a gunfight without any bullets. So you have to make sure that your fund is structured in such a way that you can maximize or optimize recovery to the extent something does go wrong. And you as a platform have to be able to do that as well.
Interesting. Well, and that was one of the questions we had as far as, or segueing to it, because it was talking about collateral level risk. I mean, pricing it, managing that risk when it comes to collateral. Maybe jump to you, Josh. I mean, yeah, pricing that collateral risk. How do you manage that collecting, so to speak?
When you say collecting, you meaning like servicing, like how we?
Well, the way Frank had kind of put it is, if you're in that gunfight. I mean,
Yeah. Well, one of the things when we first started the firm in 2004, we were really it was our first debt fund, and having gone through that global financial crisis, 2008, 2009, when the world became very, very illiquid, we realized the best way to maximize value was to build our own property management, asset management, construction management arm of the company in 2009. So that really helped create the DNA of the company, being completely vertically integrated and knowing and understanding real estate from a last dollar exposure, not just the last dollar, but also being able to execute on repositioning an asset if we had to take it over or build a building, or finding the best value mechanism to liquidate an asset. It also has helped us because we do buy performing and non-performing debt. So if you're going to buy non-performing debt, yes, everyone wants to restructure the debt, and that has changed in terms of the way we do business. We're looking to generally restructure loans, but at the same time, you got to know buying debt that they may not restructure, and you may have to go the distance. So really understanding litigation, understanding legal docs, as I started the conversation before, creating your own docs really drives a lot of that ability to enforce remedies. And then when you actually have to take over a property, or if you have to take over property, you have to be able to know what to do with it. And that's something, like Frank mentioned, it's a critical piece.
Well, and it is interesting. I mean, because growing on the infrastructure side, I mean, that's one of the fundamental issues when it comes to banks or lenders and infrastructure, is just who can manage. You want to manage an office building, not a bridge. So just as far as the real estate side, being more well positioned from the debt side to manage those types of risks.
I just want to add actually one thing, because one of the things, there's a lot of debt funds out there, and a lot of debt funds, a lot of times they outsource servicing, and to be in the business for long periods of time, you really need repeat borrower kind of relationships. So there's a healthy balance sometimes between having too much of a hammer and just, being a good counterparty. And unfortunately, one of the things that's happened in the system is, a lot of debt funds are very levered. So the more levered you are, the less flexibility you have to be a good counterparty sometimes. So one of the things I've seen over years is that, the good debt funds generally have sort of a happy medium between working with borrowers and knowing when they have to, strike a hammer, So I think that's something that has evolved, because if you always want to bid for the highest last dollar and the cheaper price, you don't have repeat borrowers, that's fine for a trade. But if you want repeat borrowers where you're not stretching every time coming back to you, it's sort of a key element to the business to have a happy medium.
I mean, it's two fantastic points there. To the extent, and we saw this, right? We saw guys last March and April really had to, have to do some serious maneuvering to survive because of the leverage levels that they carried. Now, they tended to be securities investors, but to the extent you have a lender, you have some sort of line lender or whoever knocking on your door, it gives you a lot less flexibility. The point that Josh makes about, about striking a balance, we run a stable credit portfolio. We've never had a default. We don't want a default. That's not the goal. And even though, my background is well understood in terms of my pursuit of distressed credits, and I've always run special situation strategies, et cetera, we went out to every one of our 30 or so borrowers in the middle of the pandemic and said, don't worry, communicate with us, tell us how we can help. Our goal, we know you didn't cause the pandemic, right? None of you caused it. We'll get through this together. Just be honest and do everything you possibly can to keep yourself alive. And it was amazing. You throw the documents out the window in the sense that, the cyclical, the periodic reporting, just keep talking to me every single week, especially the hotels. And I was blown away by their transparency and their honesty and how much, people really were willing to work with you to kind of make sure that they were okay and they performed. It was really actually quite inspiring.
Yeah, what I would say on this topic is, in the equity business, you're looking for the best deal. You're looking for performance, for the highest return, someone who's dependable and, does what they're going to say. In credit, it's different. You run it like a bank. It's a customer-centric business. You want these borrowers coming back again and again. You want to continue to service them. So as Josh points out, you have to be a strong and a very good counterparty and a good partner. But when you do strike the hammer, you have to do it in a fair and equitable way to come to a resolution and not, strike it with blunt force as an instrument. And we also look, because the reality is, if you're in the private debt business, you've been around for a while, you've taken some licks, right? And, you know, we tend to favor those that do have pedigree and a historical track record. How you come out of those resolutions when you have to get into some type of an amendment or, you know, recast a loan in any form, how well you do that and whether that borrower is going to be willing to come back and you're going to be willing to accept that borrower back.
Would you say, and this is open to anybody that wants to jump in, as far as being a debt fund from a lender perspective, just like you're saying, working with customers, would you say the borrowers have evolved to being less hesitant to what was the view historically that it was always kind of the hammer that was going to come down when you're working with a private lender? And now has that kind of shifted to where borrowers understand it's just another group that's going to work with you? I mean, has that been an evolution?
I would say it really has, because look, when we started the business in 2004, private credit didn't exist as an asset class. And it took a lot of explaining both to borrowers and to institutions in terms of investors what private credit really meant. And today there's so many different flavors and shapes of debt and private credit. You know, you have the vanilla, the sort of transitional lending, you have the higher value add lending. So I think what's happened is private credit has just become a very acceptable asset class and a very acceptable way for borrowers, whether you're the biggest institution or not, to borrow. A lot of that had to do with the global financial crisis and the change in the regulatory environment. So by definition, you didn't have GE Capital, you didn't have a number of lenders that were out there or large banks to serve the client in the way a debt fund can. So I think that's a major change that has only evolved, and I think it'll continue to evolve and even grow as an asset class.
Well, and that's where in the previous group, one of the audience questions, which again is a reminder for the audience, with the time we have left, you can start sending in questions for this group. So yeah, feel free to type those in. But kind of part of the discussion on the last panel was talking about basically an increase in non-traditional debt sources. Is that leading to a bubble? So again, I think this kind of speaks to that you're filling more of a vacuum, you're becoming a partner. It's not just this kind of circling, looking for about to default loans that you can swoop in on. So I think that may jump to you, Frank, on that.
Yeah, I mean, I listened to that question. It's somewhat ridiculous, right? So I agree with Dodd-Frank. I agree with the concept of risk retention. I've been around since the advent of the CMBS market. So I understood the hot potato game that lenders would make a loan, quickly flip it out, and really they're just rotating their balance sheet. And risk retention solved part of that problem, right? Because we didn't think about whether or not a loan was going to pay for 20 months while it was on balance sheet before we securitized it. We thought about it for the duration, right? And that's essentially what the debt fund has. To your first question we're the equity, we're kind of that piece or that CLO equity or however you want to kind of describe it in the marketplace. But every single position that we hold in our portfolio, we're holding to maturity. So we live or die by virtue of that credit. One of the things that has been a slow evolution of awareness, to your earlier point, was that prior to sort of really this surge in debt fund activity, what's going on, Josh was talking before about building his own risk, right? So what he's doing is he's making a whole loan, he's figuring out what part he wants to hold of that, and he's figuring out ways to place the other portions of that capital stack. Excellent strategy, we agree with it, right? Now, when a CMBS lender is speaking with a borrower, they don't tell them that they may all be going on behind the scenes. They say they're going to do a $75 loan, and then they really, they are optimizing around $61, and they find me, or they find, one of the other managers who kind of fills in that gap. But that doesn't mean that position is more risky. In fact, it should be telling that someone who, is, let's say moderately intelligent at pricing real estate debt risk is willing to hold that position for the duration. Essentially the sub B piece.
Yeah. Interesting.
Yeah, Chase, I want to make a comment there. So
yeah, the
private debt market gained market share primarily from the banks. And the banks, and I agree with Frank, Dodd-Frank was the right thing to do. And the banks, for the most part, volunteered. They abandoned that space. They gave it up. When you're a bank lender, I mean, the capital that you put into a loan is accountable to who? Millions of shareholders. That fund, you've got to look 13, 15, maybe 20 LPs in the eye. And you want those LPs coming back from fund to fund. It's one of the first things that we look at. Who are your LPs and how many are re-ups? That to us is very telling. And it kind of goes back to customer service, but we think that accountability is critical, major assessment point when we underwrite a debt fund.
And that's a great point as far as just it's not just a group out there of shareholders. You're specifically managing these relationships that you have to talk about the loans that you've made. So that is a good point to bring up. Staying on the LP side, what would you say is from the LP perspective? I mean, fundamental reasons for the growing opportunities in this part of the market. I mean, what is it that you're talking to LPs about? I mean, as far as kind of the growing opportunities when it comes to mezzanine subordinated and how you're looking at the market. So maybe start with you, Tom.
Yeah, again, I think it's driven by yield in this today. I mean, you just look back, the market really exploded post GFC. And by 2016, we were already selling the defensive attributes of debt. We were late in the cycle. From the pure yield play, it became a defensive opportunity. Then a funny thing happened within a couple of years. Half of the world's sovereign interest rates went to zero, near zero, or below zero. And we started to see more widespread interest from limited partners. The allocations now were coming from opportunistic fixed income, other fixed income buckets, both with our pension plan clients, and then a little bit later from life company clients as well. Particularly a lot of interest coming out of Europe these days. Mm-hmm. So and then who knows, I mean, we are late in the cycle again, it's been disrupted, but I think that yield element, the equity cushion are critical. And in another interesting thing, are the main selling points, but another interesting thing that I found is when we recommend debt, when the interest in debt annually tends to come in the first part of the year. We're always very, very busy from January, maybe February to June. Then it tails off again and then picks up in the early winter. And I think the reason why is because particularly pension plans, they start running their pacing models. They start looking at their allocations at this time of the year, and they focus in on their obligations. How much yield is required in today's environment? Where else are they going to get it? There are very few places. So then when we go into the year, those plans are approved, and then we stock up on debt products right away. Then it kind of, goes into a little bit of a lull. I mean, we're continually underwriting, then picks up again. So it's kind of like a cyclic underwriting and commitment process that we go through. Interesting.
Frank, any views on that from what you hear from investors, how you're approaching it? And I think maybe even taking a step back with the question is, again, fundamental reasons for these growing opportunities. I mean, are you seeing, again, with the return profile we've talked about, is it a lot of kind of equity investment dollars that are just wanting to be more defensive? Is it basic groups wanting to find more yield? I mean, what's usually the feedback you get in that regard?
Well, the first measure is equity versus debt, right? So that's the first conversation. And, over the term, the reason why I've always been in debt, and I think it's a better play. I think if you compare kind of what we do, which is the lowest risk portion of the mezzanine portion of the capital stack, we've outpaced the Odyssey since their own inception. So by probably, I guess about 50, 80 basis points. So that's material, right? Because we know we're taking less risk. So equity versus debt is the first one. And then the other slicing is, public or private. And it's a pretty easy conversation when, we're 600 basis points wide. What we do is 600 basis points wide to liquid, double B, triple B risk, right? So, and we all know from the last micro dislocation that lasted a very short period of time, that the second that liquidity was needed, it went out, triple B went out to 1,400 or 1,300. So it was the illusion that you always find when you need that liquidity. So I think that equity versus debt, I took my position on that one a long time ago, and I've never changed. And I think, now it's just showing that. So that skittishness that you see, everyone's waiting for the shoe to drop or waiting for values to dislocate. Who knows how it will happen, but it will. And I think that we haven't seen the true pain of the pandemic yet, because capital has buoyed values, right? That ever-present, whatever it is, $300 billion worth of capital that's sitting on the sidelines for North America between debt and equity investment. To the extent that that's really there, then the minute prices start to creep up, boom, there's an execution. The minute yields on debt start to come up into the 11 or 12 range, those guys, even though they may market that money at 15%, they want to put it to work. So that's really what's happening. And then public versus private credit, you're paying, as I said, 600 basis points for insurance that's not really there.
And Josh, I want to jump to you and then stay on you, Josh, again, with time we have left. I wanted to get kind of your just final thoughts, summary, just different things that you might have, parting thoughts for the audience too.
Just to this point, I think one of the things that also happened was, one fixed income debt, public debt has become more commoditized, as Frank just mentioned. The other thing that's happened is, corporate private credit was a major asset class for a longer time than real estate. And I think there's a lot of dollars from the sort of fixed income side of the house that have been typically invested in corporate private credit that will ultimately, little by little, get more experience with real estate private credit and allocate from that pocket. So I think that's an education process over time, but a large amount of dollars. And the US institutional investors are way more sophisticated when it comes to private credit. The rest of the world is catching up. So what I see from the Middle East to Europe to South America to Asia, I mean, those groups, the institutional investors on that side are really catching up, I think. So there's a bigger opportunity from an investment dollar standpoint, I think, in private credit going forward, both from a borrower standpoint in terms of opportunity set and from an investor standpoint in terms of the pie growing.
Interesting. That's really good. Again, with just a few minutes, want to get Tom and Frank's kind of parting thoughts as well too. Tom, start with you.
Yeah, thanks, Chase, and thanks for inviting me today. I from an advisor standpoint, we focus on, as I mentioned, what at StepStone we call credit sense and a mantra of playing it safe. I was on a Zoom diligence meeting recently, a lot of people on the Zoom, and I referred to the CEO who I've known for many years as a scaredy cat. So my choice of words failed me at the time, and maybe I should have had a smaller audience. But I spoke with him afterwards, and he said, "No, I actually wear that as a badge of honor. This is what defines our very, very successful firm. This is what defines who we are." And then secondly, this is a little bit of a pitch here, folks. We need a non-super senior debt benchmark. And I am on the NAICS Reporting Standards Council. We are going to tackle this. Finally, it's long overdue. And I am soliciting now the support of Frank and Josh to help us get there. There's a lot of work to do, but it's an initiative I think that is late coming and would benefit us all.
Perfect.
I'm sorry, what portion of the capital stack do you want to benchmark? I didn't hear you. I'm sorry, you cut out.
Figure all that out, Frank.
Well, I think it's incredibly important because the mezzanine portion of the capital stack is completely unrepresented. The Gillibrotto Levy is trying to do it. They're farther along than anyone. We've used it, but it is an area, because to compare us to Odyssey is ridiculous. To compare us to kind of the mortgage indexes, or corporate, it doesn't really make sense. So right. I applaud, and I'm happy to help any way you'd like.
Fantastic. Appreciate it.
Well, and staying on you, Frank, again, with about a minute left, minute and a half, want to get just your parting thoughts, and then we'll wrap and take a break here.
Well, credit yields, I mean, the biggest takeaway is credit yields don't matter if the borrower is not paying. Yeah. So I sacrifice yield all the time on deals that we feel are credit solid and credit good. Every single transaction we're looking at, the goal is for it to perform. If it is, something that we're going to just negotiate on, or a distressed credit we're going to pursue, that's a whole different animal than the way we look at the central value proposition of being in this business relative to core equity. So that's where we start. Is it credit good? Pay a lot of attention to who you're dealing with as LPs. That's I think critical. All the elements that we've been talking about on this call. Who has the ability to really go in and do what they need to do to keep you safe in periods of volatility? And what is their staying power? What is their structural staying power around the organization of their vehicle, their investment vehicle, liquidity protocols to make sure whether or not they use leverage. All these things are very important to look at.
Perfect. Well, thank you, Frank. And again, thank you to all of you for joining. Just to the audience, we're going to take a 10-minute break. And
Josh, nice seeing you. Tom, nice seeing you.
Seeing you. Thank you, guys.
Yeah, thank you,
See you,
everybody.
Josh.
Appreciate it.
Thank you.